Are we on the verge of a currency war? When you hear words like manipulation and intervention being thrown around, you really have to wonder what happens next in the trade war with China. And joining us now is Krishna Memani. He's the vice chairman of investments at Invesco. So you say the U.S. should avoid unilateral currency intervention, avoid it at all costs. Why is it so bad?
Well, so, currency intervention in and of itself is not a bad thing. People have been doing that for quite some time. Plaza Accord was probably the best example of that in the 80s. But unilateral currency intervention by the U.S. just to get the dollar lower, because that somehow, in the Trump administration's judgment, will help the overall economy, I think, it'll fail. Because when that happens, the capital markets will take it very negatively, and everyone actually would pile into the dollar. So instead of the dollar going down, will actually go up. So that's one. And second, U.S. is really a domestic economy for all practical purposes. Despite all the noise that you hear with respect to trade and all of that, most of the U.S. GDP is really domestic production. It's not exports and imports. They are definitely significant, but not a very large component. So changing that even slightly doesn't really do much. And for that, you're taking a whole lot of risk, which is basically bringing down the global trading system. That would be catastrophic, wouldn't it?
Hey, Krishna, Brian Chung here. So an interesting point that you bring up about how it wouldn't really materially impact the NX part of the GDP equation all that much. But I'm wondering, that still weighs heavily on the companies that are reporting earnings quarter to quarter and do face headwinds from the fact that a stronger U.S. dollar does have an effect on their export costs. So, I'm wondering, do you expect this to materially impact businesses in a way that would already negatively impact the negative fixed business investment that we've seen that the Fed has pointed to as maybe a reason for why they should be cutting rates?
So I'm not suggesting that the dollar has no impact on the U.S. economy. What I'm suggesting is unilateral intervention in the currency markets to bring the dollar. One, it won't succeed, and two, if it succeeds, it will be at a material cost relative to the benefit that will give to the economy. I think there's a simple way to get the dollar lower, which is the Fed should cut interest rates more aggressively, something that Trump has been pining for quite some time. I think they do that, the dollar is probably going down. Take yesterday, even with all the turmoil in the market, dollar actually didn't appreciate much. So that sort of tells you if rates go down, dollar will go down. You don't need unilateral intervention in the currency market to get you there.
Krishna, yesterday's action based on the yuan settling below 7 or above 7 to the dollar is kind of reminiscent of 2015, right, where we saw a couple different instances where there were these broad concerns in markets which hadn't been paying attention to the value of the yuan, and then all of a sudden everyone freaked out. Going forward, how long do you think investors in the U.S. stay focused on an issue that, it's down 10% so far this year? It's not like the yuan hasn't been moving at all, but all of a sudden people notice. Just from a psychology standpoint, how long do you think this remains a major part of the market conversation?
Well, so I think you make an extraordinarily important point. That is, if 5 weeks ago yuan had set down a little lower and Trump hadn't imposed tariffs or hadn't tweeted about it, I don't think you have gotten the same impact on the market. The bottom line yesterday was Trump imposed tariff, and this was seen as a shot across the bow for the U.S. economy. That is, that now the Chinese are demonstrating that they have a tool that can change things. Again, I don't think that's what their purpose was, but let's say even if that was the case. I think what we are finding out today is the fact that, yes, it is a tool, but the Chinese are very judicious, and they are playing as rational actors. As soon as they recognize the significance of that, they kind of trek back a little bit, and that's good for the global economy and the markets.
So how concerned are you right now about where we are with trade war, currency war? Is it making you change anything in how you see this market?
Well, so, trade war is by far the biggest risk that hangs over the market. The bottom line, though, is as long as we are dealing with tariffs, we can figure out what the magnitude of the downside is with respect to the global economy. Maybe it is as much as 0.5 percentage points in the U.S. GDP context. So we don't grow at 2.5%, we grow at 2%. That's bad, but it is not catastrophically bad. I think where it gets really bad is if we get into currency wars, or if we get into trade bans and things like that. Hopefully we don't get there. We think rationality will prevail on both sides, and while the rhetoric would get up and will probably stabilize at the kind of the status quo we are at, which is not a whole lot of movement, a lot of rhetoric, but the problem is nevertheless somewhat contained.
You know, Krishna, we're kind of talking about, I don't know how you would term them, right? External events impacting the economy. But if you kind of back those things out and just sort of look at the situation in Europe, you know, the state of their manufacturing economy, the state of the U.S. economy, of course, the consumer doing quite well around the globe. We're seeing a lot of stresses globally. Do you think that, you know, kind of we're going to be able to muddle through some sort of growth trajectory if we can get the trade out of the way? Or does this trade fight set us up for an event that finally does tip us into the global recession investors have been so worried about now for a couple of years?
So I think the trade definitely has a meaningful impact on business investment and sentiment, for sure. You can see that in the data. You know, if the trade issue was resolved, again, I don't think it is getting resolved anytime soon. If the trade issue was resolved, you know, that business investment component of the overall global growth probably comes back. Having said that, you know, growth has been moderating from the 2017, 2018 highs. Our expectation has been it probably gets closer to trend, which is 2% for the U.S., 1% for Europe, and probably, you know, 3.5%, 4% on the emerging market front. If we get to that, which is where we are roughly, I think we find a way of moving forward in the markets. If there are lots of questions raised with respect to that through trade or other issues, then we have an issue. Remember, policy today, monetary policy today is far more supportive, and that probably is the biggest change that has happened this year, and it's a very meaningful change.
Hey, Krishna, so on that point, though, you mentioned monetary policy. I mean, the argument was that China needed to take some steam out of the yuan because it needed to deal with the threat of tariffs that President Trump was looming. I mean, what happens with the Fed? Do you think that this also backs the Fed up? We're seeing that Fed funds futures markets are pricing in a 100% chance of a cut in October and then again later this year. So, you know, do you think that's kind of the consequence of all of this?
Yeah, I think our expectation was the Fed probably cuts 2 times this year, including the one that they already had. You know, Powell in his press conference actually boxed himself in a corner a little bit. That is, now with all of this happening, if he actually cuts rates, then he'll have to explain why this is above and beyond the mid-cycle one-off adjustment that he was talking about. If he had just left it open-ended, then the monetary policy trajectory would be whatever was needed at that particular point. Having said that, I think the outlook for interest rates, at least policy rates, is lower, meaningfully lower over the next, let's say, 12 to 18 months.
Krishna Memani, Vice Chairman of Investments at Invesco. Thanks so much for joining us.
Thank you.